everyone. This is Pragati from HR team at Mastertrust. Welcome to the latest episode of our exclusive webinar series, Street Expert. Today we have an insightful session on Bullion as an asset class. With market volatility on the rise, Bullion remains a trusted hedge against uncertainty, making it a crucial asset for investors. Joining us today as a host is Mr. Sunny Kichlu, Business Head of Broking and MT Premier Wealth at Mastertrust. We are privileged to have him guide us through today's session. We are also honored to welcome our esteemed speaker, Mr. Sanjay Gakhar, Vice President and Head of Business Development, North MCX. With his extensive expertise, he will provide valuable insight into the bullion market and its role as an asset class. We will have a Q&A session at the end of the presentation. If you have any questions, please write them in the Q&A box or raise your hand. We will allow you to speak and address your queries. Thank you.
A very welcome to all of you from the desk of Street Experts. Today, we bring an opportunity for all of us to dig deep into a well sorted upon asset class, that is bullions. Bullions consist of gold and silver. Both gold and silver not only have an aesthetic value in our lives, but since ages, they have been occupying a prominent role in our savings or portfolios. Over past few years, the flavor for bullions had seen a multi-fold increase. Not only they have a retail demand, but industrial and sovereign demand makes them all-weather friend in terms of portfolio allocation. With the advent of technology, investors are free to hold both gold and silver, not only in physical form, but also in digital form. As a result of this, the accessibility towards retail has increased multifold. Keeping all these things in view, today we have Mr. Sanjay Gakhar with us from MCX. I would request him to please take us forward in order to understand that how MCX as a platform can be used in terms of accumulating these two all-weather friends in terms of the portfolio allocations or savings, or a well-proven risk existing instrument. Over to Mr. Sanjay Gakhar. You can please take us forward.
Sanjay, thank you very much. It is always a pleasure to be part of whatever efforts Team Master Trust is doing, and this is a very nice initiative, and I'm happy to be part of this. So and good audience also, by the way.
Thanks, Sanjay. Thanks.
Good efforts put in by your team. So I have a structured presentation. I would share that with the participants here. And if there are any questions, participants can raise hands or ask at the, when the presentation is ended. Do you suggest going with only English or mix of Hindi and English? And I don't know what is it.
Mix of English and Hindi can, make it more
right.
Right? And as you rightly said, questions and answers we will take at the end of the session.
Yeah. So typically from an investment point of view, an ideal portfolio is one which where the segments of the portfolio are not strongly correlated, in the sense that when one segment goes up, the other should not go up. The strong correlation reduces the risk-adjusted returns. So an ideal portfolio is where different asset classes kind of move in such a way that the risk-adjusted returns improve over time. So gold historically has been part of the overall portfolio of investors, and it has taken kind of prime stage in the last year when the returns were quite impressive compared to the returns which we got in other parts of the financial markets. So I have a presentation I would share with the participants. 1 second. This we are doing under the investor awareness series of SEBI. So this is some kind of a smart investor awareness program. Yeah. Hope this is visible to everyone.
Yes, Sanjay, perfectly fine.
All right. And whatever I say, being from the exchange, should not be construed as part of any trading strategies or investment strategies, because whatever you trade in the derivative segment is a zero-sum game. Therefore, if somebody makes money, somebody else loses, and that is how it is kind of it exists. So nothing should be construed as suggestion from my side. We started in 2003. We are not very old compared to other global exchanges. Chicago Board of Trade came in 1845, which is like more than 200 years. So, but MCX came in 2003, and we were under the regulation of FMC till 2015, and FMC got merged with SEBI in 2015, and SEBI is the regulator of all the segments of the market now: stock market, commodities, commodity derivatives markets, and the forex, products which are traded on the exchanges. So SEBI regulates all these segments, and they're all interconnected. Uh, normally, normally as investors, uh, we hear more about the stock market, but they're all connected. If you look at a large sized jeweler which is listed on the stock exchanges, so they are listed on the stock exchange, exposure to the stock market. They are importing gold. Gold is a commodity. Because they are importing, they are also exposed to the forex market. So all these markets are kind of interlinked. And look at any manufacturing company, that is how this plays out. So therefore, we should understand the commodities space also in order to understand the stock market, so to speak. So as Sunny was saying, diversified portfolio means, so just look at the graph of price behavior of gold and Nifty over the last few years, since 2018. आप देखेंगे कि दोनों का ग्राफ बिल्कुल उल्टा है. So that is what is meant by a well balanced diversified portfolio. The negative correlation between Nifty and gold kind of evidences that they are assets which move in opposite direction, and therefore if you have both these assets in your portfolio, the risk adjusted returns improve. And otherwise, in 2000, if you talk about 2024, gold has given one of the best returns. There are factors which have led to this situation, but gold has been an outperformer compared to other asset classes, including the Indian stock market, the bond market, and the FDs. So gold has outperformed to by a large extent. Globally also, if you look at the past 2 decades, so this chart shows returns over 1 year period, 3 year period, 5 year period, 10 years period, and 20 years period. So gold has been either neck to neck in terms of returns with the other asset classes, or better than the other asset classes. And the reasons why gold is kind of negatively correlated with other asset classes is mostly it is negatively correlated. But in times of euphoria, both the stock market and gold also kind of move in tandem. But generally, it is an asset, and it is a store of value. It has no liability attached to it, and it has negative correlation with the stock market. So it has kind of performed at par with other assets. And in scenarios where stock markets went down because of global phenomena like 2002 dot-com bubble or 9/11, there the gold's outperformance was remarkable. So it is a hedge against inflation. And when the stock market is not doing that great, gold kind of moves into the positive territory, and therefore it is an ideal asset to have in your portfolio. Last year, so typically, who all are buyers of the entire gold which is extracted, mined, or processed or purified? So central banks are contribute a significant buying as far as gold is concerned. Last year, RBI was the third largest buyer globally. Otherwise, all central banks, they did like 1/4 of the purchases were done by central banks. And there are few factors which make this asset a truly global asset. And if we understand these factors, probably we can understand the gold market, the silver market, and and the commodity market in general. So as participants may be aware that the gold is typically imported into India. We don't produce fresh gold. We of course recycle and produce recycled gold, but we don't kind of mine and produce and purify gold from the Indian mines. So we import. So whatever price is prevailing in the international market would impact the prices in Indian markets. Then forex, any change in the exchange rates. For example, if the rupee becomes stronger, then the landed cost of gold will kind of come down. And if the rupee becomes weaker, the landed cost will go up. Then geopolitical factors, the trade policies. If you remember last year, the government of India reduced gold पे जो import duty 11% से 6% कर दिया, जिसके चलते the prices of gold came down. So all these factors kind of play on the price behavior of gold. So some of the examples. So what happens in terms of mathematics and what it leads to on the price of gold. So if there is $1 up movement in the price of gold globally, around 30 rupees, 27 to 30 rupees price effect is immediately reflected on MCX prices. That is, if the price of gold moves by $1, either up or down, the price on MCX would immediately change by 27 to 30 rupees in the same direction. If the rupee becomes weaker by 1 rupee, for example, if you are importing and the exchange rate is 84 rupees to a dollar, and if it becomes 85 rupees to a dollar, so 1 rupee change in the exchange rate would lead to around 870 rupees change in the prices of gold into India. So the landed price of gold would change by around 870 rupees. Similarly, silver 1 cent movement will lead to change of 27 rupees, and the $1, 1 rupee movement per dollar would lead to around 1,000 rupees change in the prices of silver. So this is just the impact of the global prices, the impact on landed cost into India, and the impact of exchange rate movements. So $1, 1 rupee per dollar movement would lead to around 900 rupees change in gold and 1,000 rupees change in silver. So these are few of the factors which we need to kind of understand. As I said, last year, the government of India reduced the import duty on gold from 15% to 6%, and therefore the prices kind of came down. So this factor also plays very important role. So this is the graphical representation of the import duties on gold and silver. Generally, the market is of gold is kind of very mature market. So the concept which we use in the context of commodities is value chain. So the value chain of gold is pretty mature. So you have importers, bullion traders, branded jewelers, the small tier 3, 4 kind of cities jewelers, and then there are exporters also. But the correlation between the global prices and the Indian prices is almost 100%. So whatever price movement takes place globally is immediately reflected into the prices in the Indian derivatives market as well as the spot market, because whatever disparity, if it comes, people would be willing to kind of attack that disparity to reduce it to zero. The products which are traded on MCX, I'll just talk about them. So gold has 4 variants. There is a 1 kg gold used generally by large players like importers or big jewelers. There is a mini gold of 100 grams. There is 8 grams contract and there is 1 gram contract. So these 4 variants are available for trading on MCX. In silver, we have 1 kg, 5 kg, and 30 kg contracts. So there are 2 types of delivery logics on MCX. One is compulsory delivery and the other is cash settled contracts. Now, compulsory delivery means that if there is an open interest at the expiry of the contract or at the beginning of the delivery period, so that would lead to deliveries. So gold and silver both are compulsorily deliverable contracts. So if you are a buyer standing on the buyer side of the contract, whether it is 1 gram 8 grams, 100 grams of 1 kg contract. So rest assured that you will get delivery of the gold, and similarly silver. And if you're a seller, if you're standing till the expiry of the contract, you would be mandated to give delivery. So it is a compulsory delivery contract. And this I am talking about futures, and options also are quite liquid on MCX for gold and silver, and they have a settlement mechanism. I'll talk about it later. But they are all interconnected kind of instruments. Gold 1 kg is like 6 contracts in a year, alternate months. Gold mini, which is like 100 grams, 8 grams, and 1 gram contract. They are gold regular, which is 1 kg contract, expires on 5th of the contract month. So if it is say February, so it would expire on 5th of the February. But the other 3 contracts, because they are monthly contracts, they expire on the last day of the contract. They are all compulsorily deliverable contracts. Gold petal. So you need to have one designated or the base delivery center for both gold and silver. The main delivery centers is Ahmedabad, and then we have additional delivery centers at Mumbai and Delhi. But for gold petal, the main delivery center is Mumbai. So investors just need to kind of understand this. Silver also, as I said, the main delivery center is Ahmedabad for all variants of silver, 5 contracts in a year. It is a bi-monthly contract, but you get deliveries in 1 kg, 5 kg, and 30 kg. All variants are deliverable. Last 5 days of the contract are the delivery days. So typically, if you look at the calendar of June, for example, and 24th to 28th are the last 5 working days. So seller can bring the material on 24th. So for seller, it is his choice to bring the material for the first 4 days, and that delivery is marked to people who are standing on the buy side. It is randomly marked. If you don't give any intention to take delivery, it is randomly marked. So that is how the deliveries take place. The margin also increases every day during the last 5 working days. The exchange is also looking at reducing this staggered delivery period to 3 days, because that is the flexibility which SEBI has given in some of the contracts on base metals, industrial metals. We have done that, planning to do the same for gold and silver as well. The process to bring material, take material, accept material, whichever contract is listed on MCX is very robust. So if you get say 100 grams of gold on MCX, it would be accompanied by proper invoice, the GST, extra 3% GST. Then there would be a quality certificate attached to it. So all properly documented, you will get. So among the 2-3 ways in which investors can invest in gold and silver, we used to have sovereign gold bond, and then there is gold ETF, and then there is gold which you can take delivery from MCX. And the fourth is you can actually buy gold from the nearby Sarafa market. So sovereign gold bond, obviously, because of the higher, because of 2.5% annual return, in terms of returns, it was a better instrument. But now that the government has discontinued that, so if you're looking at taking delivery of physical gold, so 2 options. One, you can buy from MCX, and the other is to buy from the local Sarafa market. So what people generally do, when I say people, it means investors or dwellers or users of gold. What they generally do is they compare the prices of gold on MCX and compare it with the prices prevailing in the local Sarafa market. So in addition to being a delivery platform, it also is a price discovery platform, because now you can kind of relate the prices in the nearby Sarafa market and compare it with the prices on MCX, and whichever is cheaper. So it gives a choice to both the buyers and sellers in terms of having a regional channel for buying and selling gold. And it is as a, there is a quality certificate attached with whatever material you take delivery of from MCX. So since 2004, around 150 tons of gold has been delivered on MCX, and around 5,500 tons of silver has been delivered. All 4 variants of gold and 3 variants of silver. So this is quite significant delivery by using the platform of MCX. So what generally people do is, so similar to DMAT, we have a system called Comris. So you have a Comris account where the digital reflection of delivery in your account is kind of displayed, similar to what you have in the DMAT statement. So your whatever deliveries of gold and silver you get, it is reflected in the Comris account of the clients or physical players. And once it is kind of the title is passed on to the buyer, so there is the invoice would have the gold price plus 3% GST, and then the choice is for the buyer to lift the material from the exchange designated vault or to keep it there. So some participants, market participants, keep the gold and silver in MCX vaults. The warehouse rent or rental part is quite competitive in terms of annually speaking. It is less than 0.5%. So those who want to keep the material in MCX vaults can do that. But if you want to take it out, you can take it out also. So good amount of deliveries which have taken place in terms of the overall exchange performance. So as I said, we have two segments, uh, futures and options. We are doing around 28,000 crores single-sided in futures and around 2 lakh crores in terms of notional values in options. The premium values would be averaging around 4,000 crores single-sided. So the options volumes have picked up. See, the options were permitted to be launched by SEBI in 2017, and initially the response to commodity options was lukewarm, but now the common participants who trade options in stock market, because they understand the terminology or the language of options, and only the underlying is changing. The only factor which participants kind of consider is volatility. So because the volatility numbers of commodities have been quite high because of geopolitical factors like Russia-Ukraine war, or the change of president in US. So the markets have been quite volatile, and therefore the volatility numbers have been high, and therefore people have participated in option contracts on MCX. So the growth has been quite impressive. The participants who trade options in the stock market can look at crude oil, natural gas, gold and silver on MCX as well. In terms of market share, MCX in 24-25 is around 98% of the commodity derivatives market. So practically two exchanges, NCDX and MCX has a 98% market share. And in the precious metals, energy segment and industrial metals, MCX is kind of 100% of the market. This is graphical representation of the growth of options turnover, both in terms of notional values and in terms of premium numbers. Some of the highs for gold and silver for both options, in terms of highs, in terms of open interest and in terms of turnover. So 25th November was one typical day when gold, all variants of gold and silver on 19th November did pretty well in terms of options volumes. The settlement mechanism of options contracts on MCX is little different. So this is typical terminology which we use in the context of options. So there is option price, expiry date, strike price. So all these terms, people who trade option, they understand these. So MCX also has European options which expire on the last day of the contract. Now the settlement mechanism is, if you are in the money, your option position would devolve into futures. So for example, if you have purchased one call option of 1 kg gold contract at say 75,000 rupees strike price, and on the day of expiry, if the underlying price, if the futures price, closing price is say 78,000 rupees, you are in the money to the extent of 3,000 rupees. And because you are in the money, it would not be cash settled, so you would not get, in a very crude way of saying, you would not get 3,000 rupees, but your position would become a future position on the next day. So after the expiry of the option contract, it would become a future position. So because you had purchased a call, you were in the money. So it would lead to one long contract of gold futures. So this is called devolvement. And because the position is getting created in futures, the applicable futures margin would be attracted, and it is done over a period of 3 days. So the margins are applied in a staggered manner. So if the option position is expiring on, say, Wednesday, 25% of the margin is applied on Tuesday, one day before, 50% on the day of expiry, and 25% on the next day. So Thursday, your position would be reflected in futures. So we have options on gold and gold mini, silver and silver mini. So two main contracts, gold and silver, and two each under both these main contracts in terms of variants. So there is a benefit of Section 43(5) of the Income Tax Act, where the whatever gains or losses you make on commodity exchanges can be set off against your normal business activities, and hedgers are no longer forced to take physical delivery in order to prove that their transactions are in the nature of hedging. So they can hedge without giving or taking deliveries from the exchange platform. SEBI has taken many steps to ensure that investors are aware. So they have launched a website called investor.sebi.gov.in. I would urge the participants to visit that website. Yes. Then there is Sarthi app, where good amount of knowledge about the financial journey of investors is kind of captured. There are good amount of tools and calculators. There is an online dispute resolution mechanism between the client and the member, and there is a self-certification exam also, which SEBI has recently launched, which ideally every investor should kind of appear for it. So there are certain do's and don'ts. Financial market, nobody can guarantee you returns. So if somebody says that I'll give you this amount of guaranteed return every month or every year, we request all the participants to not fall prey to such promises. And whatever transactions you do on the exchange, you should get a record. You should verify those transactions with the broker, with the exchange, to ensure that they are not off the exchange kind of transactions. Some data which typically participants from the commodity market should look at. These are few numbers. If you Google US economic data releases or US economic data indicators, you get good amount of information, and that impacts the commodity markets to a large extent. So with this, I end my discussion here, and if there are any questions, I would request you kind of.
Sanjay, I will request you to please, on your video so that we can have.
Yeah.
Sanjay, we have some Mathur who has a question that what is the correlation between gold, silver versus crude and NG, in case there is any correlation which you can make us explain.
As I said, so typically they are negatively correlated, but in terms when the markets are buoyant, every asset moves in only one direction, which is upward. So typical is negative, but buoyant markets, you have same direction movement.
Great. So Sanjay ji, to the contrary, what we say that we can do only trading on MCX today. With your presentation, we have understood it much better that even deliveries can be executed through MCX platform.
And people, sorry to interrupt you, because of the availability of 1 gram and 8 grams contracts, there has been tremendous attraction from the retail segments. Because if you want to do SIP in physical gold on exchange traded products, so 1 gram, depending upon the capacity to kind of pay margins and the delivery amount. So people typically do SIPs also in 1 gram and 8 gram contracts. So that is where you see these amounts of deliveries taking place.
So as I started that with this advent of technology and exchanges, the retail participation has gone multifold. So this gives an opportunity to retail investors to do, as you rightly said, SIP with a very small amount, and they can accumulate even a 1 gram of gold through exchange. So that becomes, and then the quality is not an issue with the exchange.
Yeah.
That That
Yeah.
is also one of the
Quality
biggest.
and safety in terms of storage. So these are the only issues which kind of bother us as investors. So
Mhm.
both quality and safety of keeping the material or whatever we buy. So these issues are addressed.
And Sanjay, as you rightly said, that I mean, not only the retail demand, but for example, the sovereign demand, which you highlighted in your presentation also, that they play a huge role during the turbulent times, wherein every country has to manage their forex reserves. So either in USD or in gold. So that also gives a natural push to the gold as a demand. And for example, for silver, industrial demand is something which has gone multifold with the advent of
Yeah.
these EVs and all. So
Yes.
silver, I mean, if you allow me, I have just done one slide on this ETFs with respect to the ETF because most of the guys, I mean, who are into ETFs. So silver and gold ETFs, they have also given great return stability to the platforms, to the
Because the
people.
underlying is gold and silver, no? So ETF is also driven by the prices
Yeah,
of gold and silver. But if you want to kind of take physical delivery, then MCX becomes the preferred platform.
becomes the preferred platform. Right, Sanjay. Any other question from the participants? That would be a good. I mean, let us make it cross interactive session. So, Sanjay ji, we have this from Mr. Ashok Kataria ji that what are the charges for taking delivery of 1 gram gold? So that becomes an interesting question for all of us.
So we keep coming out with circulars on the charges, but it is as I said, the cost to keep the material in MCX vault is less than 0.5%. So if the handling charge typically for 1 kg is 35 rupees, the rental charge is 35 rupees per day. So 35 into 365 days is annual charges. So it comes to around 13,000 or 14,000 rupees for an asset which is like worth 80 lakhs. So
Mhm.
just look at the percentage, it is less than 0.5%. So that is
Mhm.
the rental thing. But in terms of taking delivery from the exchange, the MCX price plus GST. So that is the only thing which is kind of billed.
Right. I guess any other question from participants? And Sanjay ji, in these turbulent times, I guess the gold or silver, they always make more sense in terms of hedging your portfolios. Or I mean, trying to, as you rightly said, in the initial stages that we can't keep all eggs in one basket. So that
Yeah.
gives you that opportunity also of
This we have seen,
diversifying.
no. See, the regulator, for example, is promoting mutual funds. So why mutual funds? Because they are diversified. All right.
Yes.
So instead of going for specific shares, so if the regulator is saying that mutual fund sahi hai, that is the route.
Mhm. Mhm.
So the only reason why it is being said is because they offer you instant diversification and managed by expert fund managers. So if you have an asset which is negatively correlated with the general stock market, so if you have that asset in your portfolio, so studies have shown that the risk adjusted returns. So for the same amount of risk, if the returns become better, so you should have that asset in your portfolio. So the returns have improved by including gold, and how much quantum you should have as percentage depends on the volatility of the other asset class. So if it is less volatile, if you are invested only in FDs, you don't need to invest much in gold. But if you are exposed to stock market where the volatility is high, so to counter that volatility, the investment in gold, the proportion becomes higher.
Become higher. Right. So, Sanjay, we have Mr. Gaurav Singh Arora asking that can we buy gold as a fixed asset like equity and collect margin for trading in MCX?
Yeah, you gold is accepted as collateral in MCX. So every month we can come out with circulars. So there are master circulars on items which are accepted as collaterals. But gold is, of course, it is traded on MCX, so it is one of the items.
So we have another question from Anjanelu, but I guess that is already answered that why crude and natural gas move opposite directions mostly. So as you rightly said that they are negatively correlated, but sometimes once in a blue moon when everything is going up, then probably this correlation would not stand. But generally it
But if you
stands.
if you if you talk about only crude oil and natural gas, the factors which drive these markets are entirely different.
Mhm.
So they are two other typical commodities which have typical price behavior. So if you talk about only crude oil and natural gas.
Natural gas, right. So Sanjay, we have, I mean, that is a request from, I guess, all of us, that the presentation which you have given, we would like to have that. And
Yeah, I will share with
that,
you.
so I'll
Manoj,
tell my team to get in, I mean, get that presentation from you.
yeah,
With
of course, of course,
presentation.
of course.
Any other question from anyone? That would be a great, sir. Ajay Kumar
Hmm.
has a question that can you share the PDF or QR code for NISM study? Anything?
So for that, you would need to reach out to NISM only.
Mhm.
So whichever module you want to do, and if you want to do the self-certification, that is free. So if you register there, you would immediately get the material.
Right. So we're still waiting that if we can get some more questions from audience. And
So, yes, sorry, kindly go.
anything else which you want to just, focus upon, so that, as advisors or as an investor, which makes, which makes more appeal to us, so that we go and try to accumulate this asset class, of anything which comes
So,
in
so
mind.
we have broadly. So commodities have a third type also, hedger as a participant who actually give and take delivery for consumption of that item. So typically a jeweler would buy from MCX and convert to jewelry, or that is how the hedging community behaves. Other than hedgers, so you have investors and you have traders. So these are two very important parts of the market. So whether you are investor or whether you are trader, so if you are an investor and if you want to invest in gold and silver, then MCX is one platform which you can use to invest in gold and silver. And if you are a trader, then of course commodity derivatives market. If you understand options in the stock market, then the instrument is similar. It is just that the underlying is different. But if you understand the terminology of options, if you trade options in stock market, then you can trade commodities also. That is what I am trying to say.
Right, Sanjay, because options has given again opened a new chapter to all, investors and traders as far as M6 is
Yeah,
concerned. Because with the advent of options, now even a ultra retail client can also think about going and,
yeah,
seeing that how
yeah.
these markets behave. That is also, as you are.
SEBI has also done a study showing that 90% of the retail traders lose money in options. So one
Okay.
has to be very careful while trading options. Uh, but if you are trading, then commodities also are
So,
there.
so, so, so Sanjay ji, we have a few more questions. That's good that, attendants are now getting involved. Mr. Gaurav Singh Arora asks that what margin percentage can we get from gold bought in MCX, and who to buy the spot gold? But I don't wish to get the delivery, but just as an investment with MCX. Please give elaborated process to do that.
So if I could understand, one is what is the haircut applied to gold for
So,
margins?
sir, if I can decode it, what could I
Yeah,
could understand that, someone wants to go and buy this gold from MCX, but they don't want to
yeah,
convert into delivery, and then they want
yeah.
to keep it in futures, I guess. So, what is the margin for that? If I am being able to apprehend it
So
straight.
the margin on MCX futures and option segment is typically span driven, and it is
Mhm.
you can see the website of MCX or even mastertrust to see what is the applicable margin. So that keeps changing also, but broadly for gold it is around 10-11%. So if you don't want to take delivery, one option people do is they roll over their contract. So you buy a 4 months contract, and then when the expiry is kind of coming near, you roll over to the next 4 months. So that is how people do stay invested in gold, and whosoever can take delivery takes delivery also.
So, Mr. Sanjay ji, we have one question from Priya Chaudhary. She's asking, is there any expiry date of MCX gold contracts?
Of course, it is a futures contract, so the expiry of the contract is the first column which hits you when you go to the trading screen. So typically that is what you get to see.
Right. We have another participant, Mr. Srinivas. He asks, can we take delivery of gold petal? So now this is becoming
Yeah,
interesting.
yeah.
Huh?
Of course, yes, yes. And it is
And
beautifully packed. One,
the other question is gold and silver delivery in demat form also. Demat form.
so yeah, as I said, we have a system called Comris. It is similar to DMAT. So the way you are registered for DMAT, you need to register for Comris. and I think it is free from the MCX side. Even mastertrust, many clients are Commerce registered. So if you take delivery, the material will keep lying in the vault of MCX, the approved vault of MCX, but it would reflect in your Commerce statement.
So to make it more, I mean, to decode it for further for our attendance, if anyone wants to take a delivery from MCX, just like a Demat account, they have to get their Commerce account activated at MCX. Once the Commerce is activated, so whatever, for example, whatever quantity you have got as delivery, that gets reflected in your Commerce account, just like a Demat account. This is with respect to delivery. So, sir, we have one more question that as an investor, which one would be good? Either gold ETF or delivery of gold?
I would not, being an exchange employee, I would not comment on that. But see, there are two, in terms of investment returns, probably they are at par. But if you want to take possession of the physical gold, then only MCX is there. So if you are, it is like gold, why we buy gold? One is for investment returns and the other is to have the pleasure of having gold, with us.
One has an aesthetic appeal that you have in your, I mean, hanging around here and there, and other is that you have gold.
Yeah, so it is investment product as well as a consumer product. So, which need is more powerful would decide.
So we have one more part. He's saying that from the present juncture, which asset class would be preferred for investment and better returns?
That
Gold,
Mr. Sunny Kichlu will tell. I can't tell.
gold has a overstretched while equities are in responsive phase, which may potentially generate higher returns. Well, Mr. Himanshu will take it off record. It is a very, a very brainstorm. It needs a brainstorming and completely.
But I will give you the perspective of the regulator. Investments are generally for long term, and if they are long term, you don't need to kind of think about the next 2 months or 3 months.
And Himanshu again, it is, I mean, it's not necessary that it has to be either of them. It can be both of them also in a different percentage. I mean, if, for example, you think equities are butchered, for example, the percentage could go higher to equity at this time, but gold should always be in terms of a percentage. You can go for that also. So, sir, we have Mr. Jaspal Rawatji asking, is there any benefit of cost of buying of gold in MCX in Demat form versus gold Bs? Probably the difference on the cost side. If we go for a Demat form, in terms of MCX or gold Bs?
So that typically an investor has to see and compare. So if you buy, say, 100 grams of gold on MCX, and if you buy equivalent to 100 grams gold, this ETF, what is the cost which is coming for both MCX and the ETF? So that the investor has to compare.
So gold Bs are essentially, for example, they're the units which we get from the terminal. Right? So I don't think there's much cost to it. It is just the normal brokerage and all. But as far as when you go and buy gold from MCX and you try to get it in a Demat from Commerce, right? So as you rightly said that, for example, it would be in the vault of the MCX, right? If I understood it rightly. And then you pay some particular charges to it on a monthly basis. So there it becomes, since you are trying to hold gold in the physical form, so you are paying something. Generally, we pay some fees to a locker, which we have. All of us would have a locker.
Same
Goes for Commerce. So just to answer Rawatji's answer, that if question that if we are buying gold in MCX through Commerce, we want to take delivery, then probably some wallet charges have to be paid depending upon the quantity which you have bought. And as far as gold Bs are concerned, they are normal, I mean, the units which we buy from the terminal.
Yeah,
that's great. Anyone else, if we have any some other questions? So, sir, we have Nishant. He's asking, can you please tell that which market is more volatile when we compare share market options or MCX gold options?
So I think they are comparable. The volatility numbers are comparable. So I think typically there are around 12 to 15% is the annualized volatility for both stock market and gold. So the numbers are comparable.
Great. Anyone else? If someone has some other question, so finally we have a pause at the questions as of now.
No problem.
So Sanjay, I mean, I would like to conclude it. It was a great session with you as always. We would request you to please share that presentation with us so that we can float it within our team and with us also. And any further questions if are there, I will definitely get in touch with you.
Sure, sir. Sure. Thank you very much for having me. Yeah.
Thank you, sir. Thank you.
Thank you.
Bye, sir. Bye. Bye. Thanks all. Thanks to all our attendants who have given this time for this webinar. We'll definitely come again with some interesting topic through Street Experts. Thanks a lot.
Thank you.